If you are watching silver right now, then there is one question that deserves your attention. Could a major policy shift from Washington change the way the world values silver almost overnight? The answer is not as simple as a headline suggests, but the ingredients are becoming very interesting. Silver is already trading near levels that would have seemed extreme only a short time ago. Recent market data shows silver around the mid-$60 area after an enormous rise over the past year. And now the conversation is moving beyond precious metals and into national security, industrial supply chains, and strategic minerals. That is where this story gets much bigger. The title of this video says Trump could reprice silver in 24 hours and that Howard Marks warns silver investors. But we need to separate the headline from the facts. There is no verified evidence that Howard Marks has issued a specific warning saying Trump will reprice silver within 24 hours. Marks is best known for his work on credit cycles, risk valuation, and market psychology. His recent public comments have focused heavily on expensive asset prices and the need for investors to become more defensive when optimism becomes excessive. So today, we are going to use the bigger lesson from Howard Marks rather than put words in his mouth. And that lesson is simple. Do not confuse a powerful story with a guaranteed outcome. The silver market has a powerful story right now. Silver is both a precious metal and an industrial metal. It is used in electronics, it is used in solar technology, it is used in electrical systems, it is used in advanced manufacturing, it is also a traditional monetary metal. That combination makes silver very different from gold. Gold can rise because investors want protection from currency risk. Gold can rise because central banks want reserve diversification. Gold can rise because real yields fall. Silver can respond to those same forces, but silver also has another engine: industrial demand. That second engine is why silver can move much faster than many investors expect. The latest market picture makes this clear. Silver has recently pulled back from extraordinary highs, yet even after that correction the metal remains dramatically higher than it was a year ago. Recent reporting puts silver near $65 per ounce, while noting that it remains up more than 70% from a year earlier. That is not normal commodity behavior. It tells us that the market has already experienced a major repricing. The question is whether another repricing is coming. To understand that, we need to look at Washington. The Trump administration has been pushing a much broader strategy around critical minerals and domestic supply chains. In July, the White House announced an executive order focused on securing American defense supply chains and reducing dependence on unreliable foreign suppliers. The order specifically called for stronger domestic and allied sourcing of critical materials. That matters because the United States is increasingly treating mineral supply as a strategic issue. This is no longer only about whether a metal is cheap or expensive. It is about whether the United States can obtain the materials needed for technology and defense without depending too heavily on foreign processing and production. That is a major change in the way governments think about commodities. The Trump administration has also announced billions of dollars of investment into mineral and battery projects. Reuters reported that the administration announced a $3 billion initiative aimed at strengthening American defense supply chains and critical mineral production. Now here is the important part. This does not automatically mean silver is going to explode tomorrow. It does mean that the strategic value of mineral supply is becoming more important. And when governments begin thinking about resources through the lens of national security, the market can change. Imagine a metal that is needed by industry. Imagine supply that cannot instantly respond to higher demand. Imagine governments trying to secure future supplies. Then imagine investors suddenly realizing that the metal has strategic importance beyond jewelry and investment bars. That is the type of setup that can create a major repricing. Silver is especially interesting because new mine supply cannot simply appear overnight. A mining project can take years to develop. Permits take time. Financing takes time. Construction takes time. Processing capacity takes time. Even when prices rise dramatically, the physical supply response can remain slow. This is one reason why silver can become extremely volatile. When demand accelerates faster than supply, the market does not always solve the problem immediately through additional production. Sometimes the first solution is a higher price, a much higher price. That higher price can reduce demand at the margin. It can encourage recycling. It can encourage new investment. It can also encourage substitution where possible, but all of those responses take time. This is why investors need to understand the difference between a supply problem and a temporary price spike. A supply problem can create a long-term trend. A speculative spike can reverse very quickly. And this is where Howard Marks becomes relevant even without claiming that he predicted a specific silver event. Marks has repeatedly focused on the dangers of excessive optimism and the importance of understanding cycles. His investment philosophy is built around risk awareness rather than chasing whatever asset has recently delivered the biggest return. That message matters enormously for silver investors today because silver has already delivered an extraordinary move. When an asset rises this quickly, investors start to believe that the past will continue indefinitely. That is dangerous. Silver can move higher, but silver can also fall sharply. The same volatility that creates enormous upside can create enormous downside. So when we ask whether Trump could reprice silver in 24 hours, the better question is this: could a policy announcement create a sudden change in expectations about silver supply or demand? Yes. Could a single announcement guarantee a permanent new silver price? No. Markets do not work that way. Prices reflect expectations. If traders suddenly believe that American demand will rise sharply, then futures prices can respond immediately. If traders believe imports could become more difficult, then premiums can respond. If investors fear shortages, then physical demand can increase. If industrial companies decide they need to secure inventories, then procurement behavior can change. All of this can happen faster than a new mine can be built. That is why the physical silver market deserves close attention. The paper market is important. COMEX futures are important. ETF flows are important. Options are important. But physical availability matters too. A futures contract can change hands in seconds. A mine cannot change production in seconds. That difference creates one of the most important tensions in the silver market. Financial liquidity can move quickly. Physical supply cannot. Now consider the role of the US dollar. Silver is priced globally in dollars. When the dollar strengthens, silver can face pressure because the metal becomes more expensive for buyers using other currencies. When the dollar weakens, silver can receive support. This relationship is not perfect, but it matters. Recent precious metals strength has been accompanied by softer dollar conditions and expectations around U.S. monetary policy. Gold has also benefited from expectations around Federal Reserve policy and ongoing central bank demand. That brings us to the Federal Reserve. Interest rates matter because precious metals do not pay interest. When Treasury yields rise sharply, investors may prefer income-producing assets. When real yields decline, the opportunity cost of owning metals can fall. That can make gold and silver more attractive. The Fed, therefore, remains one of the biggest forces in the metals market. But there is another twist. The Fed does not control every variable. Inflation matters. Economic growth matters. Government debt matters. Treasury issuance matters. Global demand for dollars matters. Geopolitical risk matters. And fiscal policy matters. If inflation remains stubborn while growth slows, the Fed can face a difficult choice. Cut rates too quickly and inflation could remain a problem. Keep rates high and economic activity could weaken. That uncertainty can create an environment where investors want hedges. Gold usually receives the first wave of that demand. Silver can follow, and when silver begins moving, it can sometimes move much faster. This is because the silver market is smaller than the gold market. Smaller markets can experience larger price swings when investment flows change. That is why silver can feel quiet for months and then suddenly become extremely active. Now let us return to Trump. The important issue is not whether Trump wakes up tomorrow and announces a new silver price. The important issue is whether American policy increasingly treats strategic minerals as national assets. The White House has already moved towards stronger domestic sourcing and supply chain security for critical materials. The administration has also discussed trade measures and potential price floors for processed critical minerals in earlier policy actions. That does not mean silver has been given a guaranteed price floor. It does not mean the government has declared silver worth a specific amount. And investors should be very careful with videos or posts claiming that silver has officially been repriced by the U.S. government when no such announcement exists. But policy direction matters. If governments increasingly prioritize domestic mineral supply, then miners can receive more attention. Exploration projects can become more valuable. Processing facilities can become strategic assets. Companies with secure resources can attract capital. And metals that were once treated mainly as commodities can begin to be viewed as strategic inputs. That is the bigger story. Silver is not oil, but the comparison can help explain something. Oil became strategically important because modern economies depended on reliable energy. Silver is strategically important because modern economies depend on reliable electronics and electrical systems. The scale is different. The market structure is different. The uses are different, but the principle is similar. When a material becomes essential to important infrastructure, the reliability of supply becomes more valuable. This is especially important as the world builds more data centers. Artificial intelligence requires enormous amounts of electricity and infrastructure. Electric vehicles require electrical components. Solar technology requires conductive materials. Advanced electronics require high-performance materials. Defense systems require sophisticated electronics. All of these trends can support industrial demand for silver. But again, we must stay balanced. Higher prices can eventually reduce demand. Manufacturers constantly search for ways to use less material. Technology can improve efficiency. Substitution can happen. Recycling can increase. So the bullish case is not automatic. The market must continuously prove that demand is strong enough to justify higher prices. That is where investors should watch the data. Do not only watch headlines, watch physical premiums, watch inventory trends, watch industrial demand, watch mine production, watch recycling, watch ETF flows, watch futures positioning, watch the dollar, watch treasury yields, watch Fed expectations, watch inflation, and watch the gold-to-silver ratio. That ratio can tell us something about relative valuation. When gold rises while silver lags, the ratio can move higher. When silver begins outperforming gold, the ratio can fall. A falling ratio can signal stronger silver momentum, but momentum can become excessive. That is where technical analysis becomes useful. If silver continues to build higher lows, then the bullish structure remains intact. If the metal breaks above major resistance with strong volume, then momentum could accelerate. If it fails repeatedly at resistance, then traders may take profits. If support breaks, then the market could move into another correction. Investors should prepare for all three possibilities. This is exactly where the Howard Marks mindset becomes useful. You do not need to predict every move, you need to understand what could go wrong. If you believe silver will rise because supply is tight, then ask what would invalidate that thesis. Maybe industrial demand weakens. Maybe the dollar strengthens sharply. Maybe real yields rise. Maybe global manufacturing slows. Maybe investors reduce commodity exposure. Maybe new supply comes online faster than expected. Maybe speculation becomes excessive and then reverses. A serious investor thinks about these risks before entering the trade. Now consider the opposite side. What happens if the bullish thesis is correct? Suppose industrial demand continues to grow. Suppose physical supply remains constrained. Suppose geopolitical uncertainty stays elevated. Suppose the dollar weakens. Suppose real yields decline. Suppose investors continue moving into precious metals. Suppose governments keep prioritizing strategic mineral supply chains. That combination could create a powerful environment for silver, and because silver is a smaller market, it could potentially respond with much greater volatility. This is why the phrase silver repricing is attracting so much attention. Repricing does not necessarily mean a government announces a new official price. It can mean the market suddenly recognizes that previous assumptions were wrong. That is the real danger for anyone who is underestimating silver. Markets often move slowly while investors debate the story. Then they move quickly when the story becomes obvious. But there is another danger. Investors can also become too confident after a major rally. They see the price rising. They see social media excitement. They hear huge predictions. They assume the only direction is higher. That is exactly when risk can become extreme. Silver has already shown that it can produce violent corrections. The recent market history is proof. So if you are holding silver today, you should not only ask how high it can go, ask how much volatility you can handle. Ask what your time horizon is. Ask whether you are investing in physical silver or trading paper instruments. Ask whether you can tolerate a large drawdown without selling emotionally. And most importantly, ask whether your thesis is based on evidence or excitement. That distinction can determine the difference between a strong investment decision and a painful mistake. The current environment is fascinating because the silver story is no longer only about inflation. It is no longer only about precious metals. It is becoming a story about technology, energy, defense, trade, supply chains, industrial policy, and monetary uncertainty. That combination gives silver a unique position. It sits between two worlds. It is a monetary metal, and it is an industrial metal. That dual identity can create powerful demand during certain economic cycles, but it can also create weakness when manufacturing slows. This is why silver investors need to understand both sides. If the global economy accelerates, then industrial demand can help silver. If the economy weakens sharply, then industrial demand can suffer. But if the slowdown leads to aggressive monetary easing, then investment demand can increase. That creates a complicated balance. And that balance is what makes silver so interesting. Now imagine a future announcement from Washington that directly changes how the United States handles a major group of strategic minerals. The immediate market reaction could be dramatic, but the longer-term effect would depend on implementation. Policies need funding, projects need permits, companies need financing, processing facilities need years of development, supply chains need infrastructure. So the smartest silver investors will not simply react to the first headline. They will watch what happens after the headline. That is the real test. Words can move markets. Execution changes markets. And this is perhaps the most important point of this entire video. Do not buy a silver story simply because it sounds exciting. Buy the understanding behind the story. Understand why supply matters. Understand why demand matters. Understand how interest rates affect metals. Understand how the dollar affects metals. Understand how industrial demand changes the silver cycle. Understand how government policy can change incentives. And understand that no analyst can predict the future with certainty. That includes Howard Marks. His broader investment philosophy actually reinforces this point. Markets are uncertain. Cycles change. Valuations matter. Risk matters, and investors should avoid assuming that a strong recent performance guarantees another strong performance. Silver could continue higher. Silver could consolidate. Silver could fall sharply before another rally. All three outcomes are possible. But the strategic mineral story is becoming more important. The United States is actively working to strengthen critical mineral supply chains. That is a real development. The silver market is already trading at historically elevated levels compared with the recent past. That is also real. The remaining question is whether these forces become strong enough to create another major leg higher. That is what we will be watching. So here's the bottom line. Trump does not need to officially set a new silver price for silver to experience a repricing. Policy can change incentives. Supply chain policy can change demand expectations. Trade policy can change physical flows. Industrial demand can change the balance. Federal Reserve policy can change investor appetite. A weaker dollar can support metals. Lower real yields can support metals. Geopolitical risk can increase demand for hard assets. And tight physical supply can amplify every one of those forces. But none of this guarantees that silver goes straight higher. The market can still correct. The market can still surprise investors. And the higher silver goes, the more important risk management becomes. That is the lesson we should take from Howard Marks. Do not chase certainty. Prepare for uncertainty. The silver market may be entering a period where strategic demand matters more than ever before. If that happens, then the old models for valuing silver may need to change. And that is why investors are paying attention right now. Not because a magical 24-hour repricing is guaranteed, but because the foundations underneath the silver market are changing. If you believe this structural shift is just beginning, then the next major move could be extremely important. If you believe the market has already priced in the story, then the next correction could be equally important. Either way, silver is no longer a market that investors can afford to ignore. If you found this analysis useful, then make sure you subscribe to Silver and Gold Watch. Like this video if you want more deep dives into gold-silver markets and the forces shaping precious metals. And most importantly, tell me what you think. Could silver experience another major repricing? Could industrial demand push silver toward new highs? Or do you think the market has already moved too far, too fast? Put your silver price target in the comments. I want to see where you stand. And remember that precious metals can be highly volatile. Do your own research before making any investment decision. Stay informed, stay disciplined, and keep watching the silver market because the next major move may not come from the headline everyone is watching. It may come from the force everyone missed.